The stock market is down today, but more importantly, what's going to happen in the near term future? We're entering a period where the economy is already slowing down prior to tariffs taking effect, which will start tomorrow. This is a non growth policy, and from that, the economy will slow further. The stock market will crash. Now, for anybody who's been following my content for any period of time, you know first and foremost, I'm an economist. I break down economic indicators and how they affect the stock market. What I show is how these economic indicators are sending up red flags or green flags in any particular moment within an economic landscape, and from there, how that affects the stock market. Given that, when we look at what we're looking at right now with the economy, the consumer is starting to entrench. We've seen Walmart's guide for lower growth. Consumer sentiment out of the University of Michigan came out with a very sharp drop. And now we're seeing the Federal Reserve Atlanta with GDP now, their data point that they put out stating that they're seeing negative 1.45% growth rate for the quarter Q1 that we're in right now. So you have a consumer that is slowing down. Consumer savings rates actually popped higher. They're no longer spending their money. So where do companies get revenue if the consumer stops? Given that, this is what's triggering Atlanta Federal Reserve saying that they see negative growth before we even start talking about tariffs. The tariffs are just going to exacerbate the situation. Take oil, for instance. Trump is putting a 10% tariff on Canadian oil imports. All right, Canada has flooded our economy, displacing Saudi Arabia. So now all of a sudden, Trump is artificially pushing cheaper oil higher so that Saudi Arabia can be more competitive within the United States. Because of that, we'll pay more money at the pump on an artificial basis. That is a slow growth policy. It's policy. That's where we are. But when you start looking at all these little aspects of what the tariffs are going to do on an economy that is sputtering at this point, the stock market itself will crash. When? We'll see. But the information we continue to get shows these data points. Given that, this video in particular, I'm breaking down the biggest economic indicators and how they affect the stock market individually. When you take that big step backwards and you see things, you see the slowdown occurring at a fast pace. And from that, with the stock market at near record highs, it's time to switch gears. Again, anybody who's been following me for any length of time knows that I've been pushing into Treasury bonds. Treasury bonds are high with a yield right now because the Federal Reserve is still concerned about inflationary pressures. Given that, eventually the Federal Reserve is going to have to move. I don't think the Fed is going to be too concerned about one-time increases in prices that it would be inflationary simply because the tariffs are going to push prices up immediately, but this isn't consumers chasing scarce goods. So the Federal Reserve, who also has an edict of balancing unemployment, will likely move interest rates lower faster. So when you start putting all these pieces together and you see what's going on, you can see that this is an economy that likely is going to sputter out and then really start to slow down with the tariffs. Good news, interest rates move lower. Bad news, stock market crashes. Let's jump in and let's break down the top 10 economic indicators and how they affect the stock market. Before we move forward, I do want to talk about my content broadly speaking. And I'm starting from a position of, I can't stand YouTube. YouTube is geared towards content creators that have much bigger followings. It's very difficult for me to get my footing there. And what I'm finding is I'm accelerating at warp speed on Substack. So I'm still going to be putting my content up on YouTube, but YouTube is not going to be a priority, and that's on them. They don't have a mechanism for growth, and they put all their eggs in the biggest baskets. And that's terrible for YouTube. Great, awesome. If you subscribe to my Substack email newsletter, you are going to get this all my videos emailed to you directly without advertisements. So it gives you the ability to get out of YouTube. I know some people love YouTube, great. I certainly use it for some things. I also repurpose. So my videos are going to be going straight to Substack. You can get that email. Also repurposed to YouTube and my Facebook page. I started a Facebook page and it is something I could absolutely not care much about, but there are people who are on there, so great. I will repurpose these big videos for there. Going forward, all my attention goes to Substack and then, of course, the shorter form videos. Just to keep that in mind, it might be easier for you to sign up for my Substack newsletter. That's all I'm saying. GDP now, real GDP estimate for Q1 from the Atlanta Federal Reserve. And as you can see, that's not looking good at all. And that's pretty much what we're facing. Again, this is prior to tariffs. The consumer is slowing down. Bottom line. And I've got plenty of charts to show you. You know how I break these things down. And also continuously, I am doing what I can to build up my position on my now short-term treasuries, because I think the Federal Reserve is going to be forced to lower interest rates real quick here in the next year, as well as long-term. SLY ETF is what I'm looking at. I have the world's tiniest position, and I've been waiting for that thing to pull back. It just keeps going and going, and so I'm like, fine, I'm going to keep buying and buying because I think the Federal Reserve is going to be forced. But this is really kind of the evolution of where I put together this video over the weekend. I think this popped up on Wednesday or Thursday of last week, and I kept looking at it, and I kept, we got Walmart, then we got University of Michigan sentiment, and we continue to get more and more information regarding the consumer and how they're slowing down. So that's really kind of where we are. Now, the U.S. 10-year Treasury yield, this is the benchmark. You compare everything to the U.S. 10-year Treasury, and we're trading about 4.25% interest rate. So if you're looking at investing right now, it used to be that bonds used to be it. You invested in bonds and stocks never really got there. But now there's been an evolution with the stock market, holding CEOs their feet to the fire and providing investor value was one of the sort of the driving forces over the past couple decades. So this has really outpaced bond yield. And because bond yields have been outpaced, of course, we've seen a transition of investors who now at this point, a lot of people don't even have any idea as to how invest in bonds. I just put a big video up on bond investing. And I'm also going to be continually putting out sort of explainer videos in the next couple. I think I have about 10 lined up. So I'm going to try and do one a week. Explainer videos, breaking things down so that my followers have a better understanding of some of the mechanisms of this and they have a go-to place for this. Again, a lot of this stuff is going to be up on my Substack, and that is free content up on there. But I do obviously appreciate the support regardless. 4.25%. This yield, as I'm writing this, I kind of, in between the intro and here, and I kind of looked at something real quick. It's falling further. And here's the thing, and one of the reasons why I keep pushing into treasury bonds, because the 10-year trading at 4.25%, if you bought this morning, you're already sitting on profits because the yield is now down to about 4.175. Investors are getting out of stocks because the stock market is selling off. That's a risky investment now, and pushing their money into safe haven, United States Treasury. The stock market could fall 20%, but you're looking at a guaranteed 4.25% just this morning. So if you had bought this at 8 a.m. this morning, New York time, or 9 a.m. whenever the stock market opens up, prior to any selling, said, fine, you know what, 4.25% is great. I'm going to take it because there's a lot of uncertainty in the market. You're already sitting on profits. The reason why is that 4.25% is a higher yield than the 4.175% printing right now at the time I'm doing this video. You'd be able to sell it at a profit. Consider where what happens at the end of this year. I expect the 10-year yield to be pushing, say, 2.5, 2.75. So 4.18, 4.175%, that's double, nearly. But you get the point. So in this analysis, starting at the 10, it's not where you start because, and this is such a key factor, interest rates are both a cause and effect. And you're going to hear me saying that throughout this video, that there's a lot of things that are both cause and effect to what's happening in the economy. We're seeing something happening and that's triggering something else. And the Federal Reserve will need to move in and that will be yada, yada, yada. So let's move forward. M2 money supply. And this chart here has been continually moving higher, but it peaked this month. The M2 money supply number, the whole number, was infinitesimally smaller or higher than the previous month. Effectively, and it's really difficult, if you really zoom in there, you can see that it just kind of went like this. All right, this is coincidental to other economic indicators that are showing that the stock market is likely about to crash because the growth rates aren't there. Savvy investors will get out of their stocks because they are seeing the sort of writing on the wall. They will rush in and get that 4.175% before you might have pulled that trigger. But the money supply is both cause and effect. If we have a growing money supply, that shows that banks have been lending out more and more money. That money got deposited into bank accounts and businesses are starting to expand. Consumers are getting car loans or whatever it is that they're borrowing money to get money for, to refinance, to remodel their home or whatever that might be, whatever that event was. So you're seeing the money supply growing up until this point. Now it's stalling out. Businesses will follow suit, and that's such a key factor. That at one point the M2 money supply was the cause. Now the effect of the consumer slowing down will show that the money supply is slowing down. Core CPI. Core CPI crossed the 3% mark, but PCE price index actually fell to 2.67. We just got this information on Friday. So we got a bunch of information last week. We got Walmart on Wednesday, University of Michigan on Thursday, and then personal incomes and personal expenditures as well as PCE price index on Friday. So it was a 1, 2, 3 combo there. PCE price index, the one the Federal Reserve watches, came down. They will be happy. They have a dual mandate that you can also need to simultaneously keep in mind that, inflation's easing off. Now they can look at unemployment rate. So the core CPI itself crossed over 3%, but that's an event that's already old news. That at this point, with the consumer slowing down, you're not going to see price increases as much, and because of that, you're going to see bigger gains in other areas. This is the one that really kind of hit hard: personal income growth. Personal incomes comes from the growth of the number itself, the whole number. Now on this chart, you're looking at year over year increases. All right. If the year over year increase is moving higher, then incomes convert into expenditures. That if we see more and more incomes coming in, you're going to see those individuals spending more and more. Now, there are two ways we see a growing personal income aggregate, the whole U.S. First, more people get hired. Plain and simple. You got someone who's unemployed, now all of a sudden they're employed. there's $50,000 added to the aggregate. Another way, someone gets a raise. They shift upward, they get hired at a new firm while having already worked, or they're still in the same firm but they see a raise. So those two things, when you see that aggregate growing and growing at a pace, expenditures follow suit. From that those expenditures turn into revenues for companies. So to see personal incomes pausing was not good news, because not only are we seeing a slowing growth rate in personal incomes, when it comes to consumption, we're seeing a growth rate that is actually falling faster than incomes. The reason why? The saving rate. Personal savings, I've got that chart here in a second. There was a big jump higher in personal savings, the savings rate here in the United States. So we're seeing less income being created in the economy, whether individuals are losing their jobs, which, yes, all the stuff we saw with the federal government, all the firings, that hit. But we're also seeing just a moderation in the pace, that there's no more growing. And because of that, the extension is personal expenditures are falling. Consumers are no longer spending at a pace that they were previously, and we're seeing this tap out. Higher costs, interest rates, things like that. Concerns of inflation and price increases, policy shifts. Consumers are definitely concerned about the policy shifts. Yeah, it'd be great to see the budget get balanced. Would be totally on board with that, how that's happening. But the way it's actually happening, consumers are a little disconcerted, to say the least. Here, just a real quick, this is personal incomes and personal expenditures. I wanted to put a combination of these two charts together so that you can see the strong correlations. If we have that income increasing, you can see how the expenditures follow suit. Savings rate. U.S. savings rate jumped higher. That's bad news. It's good news, but it's bad news. When it's good news, that's a great thing. When it's a good thing. Right now, not a good thing. The economy will slow down. If the consumer seizes up and says enough is enough, we need to save money, we can't get ahead. Which the consumer has started that process of spending less and saving more. Think of the trickle-through effects of how that will play out within the economy. Revenues for companies are going to slow down. Price-to-earning ratios are going to get shocked. And the button will be hit to sell fast. When you start putting all those things together, because interest rates are as high as they are, mortgage rates, things like this, credit card interest rates, car loans, you're going to see how this economy seizes up rapidly. But at the same time, the tariffs don't hit until tomorrow. Immediately, the total number of goods being purchased drops starting tomorrow, because there's a tax on every single thing up to 25%. Then when you consider how these tariffs are going to play out internationally, and this is something I really don't see too much content about on some of the places that I haunt, Canada is a perfect example. They're saying anything but American-made goods. And boy, are they standing up proudly and saying, I'll spend more on Canadian products before I will buy an American good. Awesome. Great. Real proud for you. Think about the American companies who are going to report lower numbers. So while those Canadians are shifting out of American-produced products and instead opting for Canadian goods, they're employing Canadians. Whereas you're not seeing any of that here in the United States. So this could be a real faceplant for the policy of bringing jobs to America, because other countries are going to see jobs happening there out of protest. It's one of those things that I'm putting together and I'm like, I don't see anybody talking about that. Initial claims, unemployment. Unemployment will rise. Think about this one tax that you have. Every time you go to the pump, you're going to have to pay a bit more. All right? Canada has supplanted OPEC and Saudi Arabia, and they're not exactly happy about that. If you looked at the charts, and I've done enough content on this one particular subject, if you look at the charts of Canadian oil rising as much as it has since 2008, the financial crisis, we've seen a big, huge move higher in the amount of oil being consumed here in the United States from Canada, while simultaneously Saudi Arabia and OPEC have seen a complete decline. All right, the amount of oil we got coming in from Canada has gotten rid of the amount of oil we have coming in from Saudi Arabia and OPEC. Saudi Arabia and OPEC are not exactly happy about that. Now all of a sudden there's a 10% tax. It's not going to amount much to me at the pump. I have more than one car. One of them is a Mini Cooper, convertible. I opt for it because I get nearly 40 miles to the gallon versus, the Land Rover or anything else. All right. Over the course of the life of me having that car, I'm going to save about $17,500 over, say, the next 10 to 15 years. That's my go-to car. I love that car. It's not going to affect me that much. But think of every single individual across the board here in the United States who are having to pay 10, 15, 25 cents more per gallon, whatever it might end up being. It might be 50 cents, it might be 75 cents. It depends on location and how it plays out. That money can no longer be spent at restaurants. That money can no longer be spent at grocery stores or on clothing or things like this because of that tax, that artificial push higher. So we're going to see other areas declining because there's no longer expenditures there because we have to drive our vehicles. We have seen, this is initial claims, you can see there's a pretty decent sized jump higher there. That previous spike back there, if you're looking at this chart right where it says February, you see a spike there. That was from the hurricanes. All right, so events pushed these numbers, initial claims. This right here, we can write this off actually, because this is mostly federal employees who just got fired. Federal judge basically just said, you can't do what you just did. They're all back on the payrolls. Have a nice day. It's going to cause a little bit of a problem, but we'll see how that plays out regardless. So I think that this one goes away, but long term, companies are going to shift because they're going to see less revenues coming in and they got to protect their bottom lines. Let's get rid of the fat. Unemployment will go higher, which means personal income growth goes lower, which means consumption goes lower, which means revenues for companies go lower. PE ratios starts to flatten. That's how that all plays in, that it becomes cause and effect. University of Michigan sentiment, consumer sentiment hit. Again, you can see the sharp drop. Consumers all of a sudden are like, we're not happy. Things don't appear to be rosy. What did consumers do? Stop spending, start saving. Their sentiment dropped. The Federal Reserve is going to have to react. I'm getting ready for that. Here I wanted to, this is the same chart, again, University of Michigan consumer sentiment versus expenditures. And you can see there's a strong correlation between sentiment and expenditures. And expenditures, of course, and I will reiterate this until the cows come home, expenditures convert into revenues for companies. The consumer is tapping out, seizing up, stopping spending, saving more. Sentiment is dropping. Expenditures are following suit. That will decline sharply over the course of the next 3, 4, 5 months. Revenues will follow suit. The stock market will crash. Housing, one of the bright spots for now, sort of. We're seeing a decline in prices. This is Case-Shiller price index. Now, the thing with Case-Shiller and what's going on in the prices right now for housing, it all boils down to two things. First, mortgage rates and supply. Now, one of the things that is obvious is if you've seen any of the content coming out of Florida, the content creators, and there's a couple that I follow, they're showing how Florida real estate, there's something like 2 million vacant homes right now currently in the state of Florida. All right, Florida is becoming an outlier. Prices are dropping. So on a national basis, this chart right here is going to fall. So on a national basis, it's going to look as if we're seeing improvements. But the good thing is once the Federal Reserve starts shifting and starts lowering interest rates, mortgage rates will decline. That will give individuals the ability to afford housing a little better. So there's that sort of bright spot there. There's just that big problem of there's not enough supply. And I do enough content on housing to show that the supply issue is a big issue. Housing retailers, Williams-Sonoma, it's always that poster child in the one ETF that I follow, and I'm sitting there saying, how did you become the number one? Whatever. I'm digressing on that one. You're going to see those stocks moving lower and lower. And I've put out enough content on home builders ETFs and how I'm shorting that and have done pretty well on that so far. And I expect that thing to just flatten. There's not enough supply. Anybody who was actually swinging a hammer, they just ran for the border. Back. So who's building these houses? Then you have the factor in the fact that, like building a house, we get our lumber from Canada. We get building supplies from China. Those tariffs just shot the price up even further. So we have a lack of supply. Building new houses is going to be expensive, and there's no one there to actually swing the hammers. Fortunately, the mortgage rate is falling, of course. And here's a look at the 30-year mortgage fixed, 6.75%. I can expect at some point within the next, say, 1 to 2.5 years, we'll be moderating below 4.5%. Home affordability will certainly be there. The only issue, of course, is there's not going to be supply enough. That's going to be a push-pull situation there. It'll be a quality versus quantity within the industry. And because of that, the housing industry could, although we're going to see prices drop, we could see all those home builders ETFs that I love to sell short because I think they're going nowhere. I'm going to make some money on that one. And this brings us all to the stock market. The stock market is, of course, selling off. It's moved lower since I put this chart up, and you can certainly update your own charts on that. We've hit the peak for this cycle. This bull market is done. And I expect we will be printing some pretty low numbers. I expect that we're going to see big shots downward, then a recovery. The Federal Reserve will step in, save the day with lower interest rates, but it'll be too little too late, and eventually we'll see the stock market moving lower again. And it all boils down to revenues and profits for companies, which are driven by consumers who are stretched and tapped. And now they're going to have to pay more because of tariffs. Companies are going to go in and say, cut the fat, which means more unemployment, which means lower growth rates for personal incomes, which means even less expenditures, which forces the Federal Reserve to lower costs further. So credit card costs and home loan costs, mortgage costs will drop. But at that point, the damage is already being done. And the Federal Reserve won't be able to move to an accommodative stance fast enough to save the stock market, that the stock market will sell off. Now, this is a lot of information all at once. Again, I'm going to be putting out some explainer videos. I think this week my explainer video will be how the bond market works. And then, because I've been, specifically the Treasury market, because I have been getting so involved in bonds, I get a lot of questions coming in via comment sections and things like this from individuals who aren't quite certain how the bond market actually works. Personally, I'm in TLT ETF. I have the world's tiniest position on SLY ETF. Would have loved to have seen some pullback on SLY ETF, which just keeps skyrocketing. The Federal Reserve will shift, and they're going to be lowering interest rates rapidly. Because of that, SLY ETF will shoot up even further. So I will be putting out more content on TLT ETF and SLY ETF. That one's going to be hitting this week as well. I have it scheduled for this week. So make sure to hit the subscribe button, like, follow, all that stuff. But Substack or Facebook, whichever your preference is, or if it's here on YouTube, wherever you're finding me at this point. Thanks so much for the support. We'll see you in the next video. Make sure to follow along because it's going to be a fast-moving ride.